So the housing market continues to scream higher, with the Redfin median home sale price up 4.7% year over year and close to the all-time highs seen in summer of 2022, while the Case-Shiller Home Price Index has smashed through into new all-time highs. It seems like the housing market has been unfazed by the sustained high interest rates that we have seen over the last couple of years, with the 30-year fixed-rate mortgage rate still hovering just below the 7% mark. However, recent economic data is emerging to suggest that this could all be about to change soon, with home prices potentially set to start plummeting before the end of 2024 for several different reasons. And one of these reasons is a never-seen-before demographic trend, which is really quite shocking. So with house prices currently sky high and mortgage rates still above the peak that we saw during the global financial crisis and also far higher than the historical average, we are seeing home buyer housing payments surge beyond levels that are sustainable. Housing payments for a median priced home are now at $2,700, which is a 9.3% increase year over year, which is also about double the average housing payment that was seen at the beginning of 2021. This is squeezing many homeowners to the absolute limit financially, as it now requires 34.4% of the median household income to make the monthly mortgage payments on a median priced home. And when you consider the fact that the cost of everything has risen in recent years, not just housing, these elevated housing payments are pushing many over the edge to the point where they simply can no longer afford to keep up these payments. And this is evident in the number of housing foreclosures that we are seeing steadily rising upwards. Now, this payment to income ratio is roughly double that of March 2021, when rates were in the low 3% range, and once again, yet another metric that is above the peak that we saw during the global financial crisis of 33.8%. And this is not just affecting a few regional markets, as every single one of the nation's 100 largest markets is less affordable today than its long-run average. Now, these elevated housing payment costs are having a big impact on the quality of life for both homeowners and also renters, according to a new study by Redfin, which does suggest that Americans are being forced to make a number of sacrifices to afford their payments. Half of homeowners and renters struggle to afford their housing payments, and 1 in 5 people who struggle with this have skipped meals, worked extra hours, and/or have sold their belongings to cover their costs. They did also find that 1 in 6 have delayed medical care, which just shows how desperate the current housing affordability situation has become for some people. And while many of those people already on the property ladder are struggling right now with these payments, the barrier to entry for those who do not yet own a home is becoming even bigger. Now, homebuyer down payments jumped 24% in February on a year-over-year basis, now at $55,640. This means that the typical down payment is now 15% of a typical home purchase price, which is up from 10% just a year ago. Mortgage rates still being sky high is tightening the affordability criteria for new mortgage applicants and is leading to new home buyers having to scrape together more cash to put down a larger down payment in order to have a smaller loan. But another reason for this rising down payment is the fact that the housing market has continued to surge despite these high mortgage rates, with home prices rising 6.6% year over year in February. And on top of this, the typical household earns roughly $30,000 less than what is needed to afford the median priced home right now. Buyers need to earn $114,000 in order to afford a median US home, which is 35% more than what the median household income is. This gap between what the typical household makes and what the typical home costs is not quite as large as the peak that was seen in October of 2023, but ever since 2020, it has been generally trending in the same direction of getting worse and worse. And compared to a year ago, home buyers need to make 12% more to afford a typical home, and this pace of income growth that the market is demanding is simply not the reality for many households who are wanting to get on the property ladder. And as you can see from this chart, while income needed has surged over the last couple of years, the growth in median household income is severely lagging behind. And even when we focus on only the smaller starter homes, first-time buyers must make $76,000 on average to afford a typical starter home, which is 8% higher than a year ago. This is nearly twice as much as before the pandemic, and it means that it is becoming increasingly harder for those who are younger and/or are on a lower income to afford a basic starter home. This is leading to younger people having to wait until they are much older with higher incomes for them to be able to afford a basic starter home, and also leaves many who cannot raise their income trapped in this cycle of renting and never being able to own. Unfortunately for homeowners who do have a mortgage, it's looking like mortgage rates will not be coming down anytime soon, as the last few inflation readings have come in quite hot above analyst expectations and still not cracking through the 3% barrier, meaning that we are still a way off the 2% central bank target. There are now rising concerns that the Fed has not yet defeated inflation, and we could actually see inflation start to head back upwards rather than continue downwards. Freight and shipping costs have spiked upwards recently, partly due to the rising global conflict and the strain that this is putting on the global supply chains. And over the last few weeks, we are also now seeing oil and other commodity prices surge, which is also going to put upwards pressure on product prices and therefore future inflation figures. Due to this recent economic data that we are seeing, markets are now predicting that there will be just 2 rate cuts in 2024, which is a lot less than between 5 and 6 that was being forecasted at the start of the year in January. And there are even some experts and analysts that do think that there could actually be no rate cuts this year at all. It's clear that many people are being pushed to the limit when it comes to housing payments, but with mortgage rates likely to stay elevated for the foreseeable future, there's unlikely to be any relief from this element of housing affordability. And if we do indeed see cracks emerge across the housing market due to rock bottom affordability, then it is likely to therefore come from home prices declining to levels that are more affordable for the average person. Now, another very interesting phenomenon that could soon have a massive impact across the economy is a wave of homes hitting the market from distressed retirees in what looks to be a looming retirement crisis that America is facing. Now, retirees are not only set to live longer than ever before, but there are also far more people retiring every year compared to new people who are entering the workforce. And this is set to put massive strain on the social security system, which for the last 15 years has been paying out more in benefits than it has been collecting in social security revenue. And this is of course a major problem, because at this rate it will be completely depleted by the year 2034, meaning that there will be no social security payments for retirees, or if not, they will be a lot lower than what they are right now. A US Census Bureau survey found that almost half of Americans between the age of 55 and 65 have no savings in personal retirement accounts, which is partly due to the tens of millions of workers who are in part-time or gig jobs that offer no clear retirement contribution plans. And 40% of current retirees rely solely on Social Security to live, meaning that this older age group may soon have to find other means to sustain themselves throughout retirement, which may have to be selling their house for a lump sum of cash. Now, 1 in 3 homes in the US are owned by over 65s, and many retirees are homeowners who have paid off their mortgage in full, or at least have paid down a significant equity on their home. And with many retirees not having enough income coming in to sustain their living costs, especially if social security payments are cut partially or for good at some point in the future, it would be logical to see many of these retirees sell their home for a big lump sum of cash. Home prices have of course risen a lot over time, so a lot of these homes owned by the older generation are worth a fair bit. Retirees could use this money to downsize, either by finding a place to rent or buying another smaller property, or even move in with their children, which is a trend that is starting to emerge. There are approximately 144 million homes in the US, and we know that over 65s own 34% of these homes, which equates to about 49 million homes. It is impossible to try and guess how many of these homes may end up getting sold by pensioners who need this money, but even a small percentage could have a substantial impact on home prices over the next decade. This demographic shift could therefore put a lot of downwards pressure on the housing market, which could lead to home prices seeing a significant decline as a result of this. BlackRock's CEO Larry Fink has issued a number of major warnings for the US economy in his recent letter to shareholders, including the retirement crisis I mentioned in this video. My previous video goes into more detail on this topic, and you can check it out by clicking on screen right now. Aside from that, if you enjoyed the video, please leave a like and subscribe, as it does help out the channel a lot, and thanks a lot for watching.